What's the real difference? You're ready to invest, but you're stuck. Should you wait until you have a big chunk of money or start with what you have now? People love to agonize over this. They create spreadsheets, read endless articles, ask friends for advice, everything except actually getting started. Let's cut through the noise. Is starting with $10,000 automatically better than $100? Not really. The answer is more about you than the money. Sure, a bigger initial investment gives you a head start, but focusing only on the starting number is a rookie mistake. The real difference is about the habits you build, the mistakes you make, and the lessons you learn. Starting with $100 is your training ground. Starting with $10,000 is jumping into the deep end. Think of it like learning to drive. Would you rather start in an empty parking lot or on a 6-lane highway in a Ferrari? The $100 portfolio lets you learn the basics without the terror of big losses. The $10,000 portfolio puts you straight onto the highway. Higher stakes, bigger rewards, but also bigger emotional costs. The journey is what forges the investor, not the amount you start with. Debating the perfect starting amount is just procrastination. The real difference is about the investor you become in the first 20 months, not the final dollar amount in 20 years. So let's break down what this really looks like, from the math to the psychology, and show you why the best time to start is right now. The unseen power of starting small. Why your first $100 is a giant leap. Investing your first $100 won't make you rich overnight. The financial return is tiny, but its true value is in momentum and education. That first $100 turns you from someone who wants to invest into an investor. That identity shift is priceless. You have to pick a brokerage, link your bank, choose an investment, and click buy. These steps are foundational habits. Once you've done it, doing it again is exponentially easier. Waiting for $10,000 delays building these systems and keeps you stuck in analysis paralysis. That first $100 is the push that sets your wealth in motion. Suddenly market news matters to you. You start learning passively in a way you can't from a book. It's the difference between reading about swimming and actually getting in the water. Most people say, I'll invest when I have more money. But by investing $100, you prove to yourself that you can start now. This psychological victory is massive. It rewires your brain to focus on what you can do today, not some imaginary perfect future. That mindset shift is the true engine of wealth. Start small, but start now. Let's compare two investors. Alex starts with $100, Ben with $10,000. Both invest $100 every month in a low-cost index fund, earning 7% annually for 20 years. Alex contributes $24,100 over 20 years. With compounding, her portfolio grows to about $52,500. Ben contributes $34,000. His portfolio grows to about $91,500. The math is clear, starting with more money leads to a bigger outcome. But look closer, Ben's extra $39,000 comes almost entirely from his initial head start. Both investors built substantial wealth. The real winner is the one who starts and stays consistent. The most important factor is the consistent automatic monthly investment and the 20 years of compounding. The real loser, the person who waited and never started. The lesson: start with what you have and let time and consistency do the heavy lifting. Don't obsess over the starting amount. The system works for both small and large beginnings. The only way to lose is to never get in the game. Start now and let compounding work for you. The earlier you start, the bigger your advantage. Where the real gap widens. The difference in Alex and Ben's results comes down to compound growth, your money making money, and then that money making more money. Ben's $10,000 is a bigger snowball, so it grows faster. If he never added another cent, it would still grow to nearly $39,000 in 20 years. Alex's $100 would grow to just $387. That's the power of a larger starting amount. But the most critical element is time. Compounding needs years to work its magic. Early gains seem small, but in year 20, the returns are huge. The magic happens in the later years. Starting early, even with a small amount, buys you time for compounding. Waiting to save up a big sum means losing years you can never get back. The real gap isn't between Alex and Ben, it's between those who start and those who keep waiting. Don't let the compounding clock tick away while you're on the sidelines. Investing isn't just math, it's behavior. Starting with $10,000 creates commitment. You pay attention, stick to your plan, and treat it seriously. This can lead to better habits, but also more stress. The more you invest, the more you value it. This is the IKEA effect. With $100, it's low stakes. You can learn without fear, but it's easy to ignore or stop contributing. The key is to treat your $100 with the same seriousness as $10,000. Build systems, like automation, so your discipline doesn't depend on motivation. The successful small investor is the one who acts like a big investor from day one. Your mindset, not your starting amount, determines your long-term success. Build habits now, and you'll be ready when your portfolio grows. On paper, a 10% drop is a 10% drop, but the emotional impact is worlds apart. For Alex, a 10% drop means losing $10. It's annoying, but not devastating. She learns to stomach volatility in a low-risk environment, building emotional resilience. For Ben, a 10% drop is $1,000, a rent payment or a plane ticket. That's real pain. The emotional pressure to sell at the wrong time is immense. This is why your biggest enemy in investing is yourself, not the market. Starting small lets you train your reactions and build your volatility muscles with light weights. By the time your portfolio grows, you've already learned to trust the process. Starting big with no experience is like lifting heavy weights with no training. You're more likely to get hurt. The lesson: use small amounts to build your emotional resilience. Learn to handle risk before the stakes get high. Your future self will thank you. The best investors are the calmest in a storm. Fees are the silent predator eating your returns. For small investors, fixed fees or account minimums can wipe you out. A $25 annual fee on a $100 account is a disaster. Choose modern, low-cost brokerages with no account minimums or annual fees. For larger investors, percentage-based fees, expense ratios, are the threat. A 1% fee on $10,000 is $100 a year. A low-cost index fund might charge just $4. Over 20 years, that difference adds up to thousands lost. Your job: keep costs as low as possible. Always choose low-cost, diversified index funds and ETFs. Don't let high fees rob you of your rich life. Small differences in fees make a huge difference over time. Here's your practical blueprint. First, automate everything. Set up an automatic transfer from your checking to your brokerage every month. Don't rely on willpower, make it automatic. Second, choose the right account and investments. For most, a Roth IRA is the best start, tax-free growth and withdrawals. Inside, buy a single low-cost diversified index fund or a target date fund. Set it and forget it. Third, reinvest all your dividends. Turn on automatic reinvestment so your money compounds even faster. Finally, be patient. Don't check your account daily, don't panic when the market drops. Your automatic contributions mean you're buying at all market levels. This is dollar-cost averaging. Your goal isn't to get rich this year, but to build long-term wealth. Follow this system and your $100 will become $1,000, then $10,000 and beyond. The system works if you let it. Don't chase hot stocks or try to time the market. Simplicity and consistency win. Start now and let time do the work. Your rich life begins with your first step. So what's the verdict? The amount you start with is one of the least important decisions. The most important decision is simply to start. The person who invests $100 today is ahead of the person waiting for $10,000. They've conquered inertia and started the compounding clock. The endless debate over the perfect amount is just paralysis by analysis. There's no risk-free path to wealth. The only guarantee is that waiting costs you more than starting small. Your financial journey is a marathon, not a sprint. The first mile is the hardest, but you just need to cross the starting line. Investing your first $100 is that line. It builds confidence and habits for life. As your income grows, increase your contributions. Small, consistent efforts snowball over time. So do something today. Open a brokerage account, link your bank, set up an automatic transfer, and pick a simple, low-cost fund. The biggest risk isn't losing money. It's looking back in 10 years wishing you'd started now. The most important number isn't $100 or $10,000, it's zero. The amount of time you should wait to get started. Your starting line is now. Go cross it.